Boom.
All good.
So, Irina, thank you so much for joining us today. We're halfway through the Spotlight program. We've got 42 teams in the program this year. Not all of them will be able to join the session, but the ones that are in the session are expecting, a pretty much open conversation about your journey, about your expectations in regard to the investment decisions. We'll move on to all the details of the conversation for the next 1 hour and a half. To begin with, again, thank you so much for joining us. Guys, I'm super excited to welcome Irina. As you know, partner at Atomico, leading sourcing, diligence, and managing Atomico's partnerships on healthcare and bio, enterprise, and then her background is, I just don't want to summarize her background in regards to, you have to scroll a couple of times on LinkedIn to see all the expertise that she's got and all the things that she's done before Atomico as well. So I hope you all did that and looked into her background. And obviously, we'd like to address you a couple of questions on your starting point as well, and how you made the shift from surgeon to the investment landscape. If you don't mind, I would like to welcome yourself to actually make a quick introduction on yourself right now, and just to say a couple of hi and any questions you might have for the teams initially.
Of course. So hi, everyone. It's really great to be here. My name is Irina. I'm a partner at Atomico. Atomico is one of the largest venture capital funds in Europe, investing kind of at Series A or beyond, although Series A is changing shape these days. And I'm a partner in the in our early stage team. So I mainly lead investments in Series A, B companies. I am one of the two partners that focuses on our B2B and enterprise investing. And I also, and that's kind of like across both, mainly horizontal platforms. And then in terms of like vertical SaaS or vertical sector focus, I cover healthcare. My background is, I started life in medicine. I've trained in Romania, then in Germany, then was a surgeon for a couple of years before moving to the dark side. I joined the consulting company Bain after a couple of years of medicine, spent there 6 years. I was part of the global team, a leadership team there, worked with over 30 companies in 10 countries in that period on both kind of diligence for investment funds, looking at a variety of industries, but also digital transformation. So working on kind of like the tech practice at the time, as well as of some of the life sciences areas. And then I joined a later stage investing fund for 4 years and joined Atomico and have led 6 of our investments in the last 4 years here. And look, the objective of this is to make it useful for you. So very happy to answer any questions, and I'll be as honest as you want me to be.
That's absolutely fantastic. Thank you very much. So maybe this is one thing we can start with. How would you describe the profile of the founders you're looking at from the point of view of their expertise, preparation, background, and even going through the soft skills side? So what sort of things are you looking at in regards to the founder market fit, if you want?
Sure. So personally, I always kind of look at the founder story and why behind their building what they're building, and what I'm looking for is, do they have a differentiated insight into the problem they're solving, and do they have a deep understanding of the space they're playing into, and that's reflected in how product focused they are and how they build the product, and also the product vision for the future. So I always look for that depth and insight, but then obviously you need more than that, right? A lot of the things about a company are about building an organization. So it's about building a team, and that comes with, you know, ability to attract high caliber talent. So that's another thing I would look at. I mean, in the early days, it's obviously harder, but you can already say like who is around the table, which talent they've managed to attract to that date, and also how they think about scaling the team and scaling the organization, and also kind of like with self-awareness in mind about what are the areas where they need to complement, right? And sometimes that comes in a co-founder relationship. Sometimes if it's a single founder, it comes in the people they brought in the team. But I and I guess that's kind of goes into the more and more soft skills. And then I think lastly, what's also very important is the ability to the art of storytelling, in the sense of you know, not kind of like being salesy, but actually telling the story about the company and the vision. And that's important for investors, that's important for employees, future employees, that's important for current employees, and for customers as well, right? If founder is able to succinctly create a compelling vision and tell a story that you want to listen to and be part of, that's a sign that they'll do that with customers, they'll do that with teams. And then I think lastly, there is a little bit of like that commercial sense. I mean, depends again on the founder. Some founders are very commercial because they come from that angle. If they're more technical and that's where they come from, you want to make sure they understand the commercial considerations, and that they also are happy to put a product out there, reiterate, you know, have that mindset. That's the opposed mindset of academia, right? Which is wait for perfect, or of some you know, very technical profiles in engineering that kind of like want to build a perfect product. But actually a lot of the times it's not about the perfect product, it's about also being able to work with your customers and put it out there and kind of like fail and have it fail and build it up again. So I mean, it's a lot of things, but it also depends very much on the space and the business they're operating on, like where we put more emphasis on among these elements.
Would you say so? The stage of the companies in spotlight right now is pretty much seed focused. So we're looking at Series A and beyond in regards to maybe the future for some of them. So what I was, since we were discussing this art of storytelling, does anything change in regards to storytelling, or in regards to how they should discuss about their business as they move from seed to Series A? To put it into context, so we've got, for example, this concept of concept-driven versus data-driven type of style of pitch decks and storytelling. Should they make this the switch from concept-driven and more focused on the vision versus data-driven in regards to what interests you more, if you see a difference in between those two approaches of storytelling, if you want?
I mean, I think you have to have a high-level vision-driven story underpinning everything at all times, even when you are a $3 billion company, right? It's, if you look at the S1s of companies that go public, they still have that, right? The mission is one of the first chapters in that. And I think that North Star is what helps you through kind of like, you know, ups and downs and fluctuations and so on and so forth. So that is obviously the overarching ones. Now, different stages will require different things, right? If you are just pitching the idea and you have not built a product, or you just have an MVP, then MVP, sorry, then you don't have that much data to put on around like customer feedback or traction. If you're a bit later, you will have those data points, and they are, but the way I think about it is they're supporting your story. If you think about what the vision is and what the story is and where you want to go, there's steps in that journey, and at every step you just have to kind of like confirm them with data or information or qualitative data, and it kind of increases the more mature you are, but it's the same underlying narrative that powers it in some ways.
Good.
So yes, I mean, if you have data, if you have traction and you have customers and you start to have feedback. Of course, adding that data to the story is important, but it should be as a supporting argument and as an enabler of the vision. But of course, if you're, Series A, Series B company, especially Series B, C, you can't just go on with like a high level story. People will want to know a bit more than that at that time.
Guys, just wanted to thank you so much. Just wanted to remind you, so if you've got a question, just raise your hand. We'll keep the conversation going, but just as a reminder that this session is for you. So whenever you've got something, you can put it on chat, but mainly just raise your hand, and don't forget to say a couple words about yourselves when you address the question, so that Irina knows a bit about your business and your background. Great. So if we are to discuss a bit about deep tech, I think you've been asked quite a few times, right? So how would you describe deep tech, and what are the changes and the new, the transformations that this industry or this trend or this, new era? So how does the future sound like, and what are the changes that we should be aware of in regards to what deep tech companies are, and in particular to how startups should take this area into account? So how would you explain what deep tech companies are?
Well, I think the deep tech of today is the mainstream of tomorrow often, and I kind of tend to stay away from a very specific definition, but in generally it is companies that have some sort of like breakthrough scientific or technological or engineering innovation at their core, and they are the ones bringing it or using, maybe concepts from academia and putting it into like an actual business. But it stems everything from, there's also like gray area, right? Like, where do you put the more technical end of software? Is applied AI deep tech? You could argue that it is, and you could argue that it's not. And then I think there's kind of obvious deep tech areas, which are quantum computing. Yes, it's probably pretty deep tech, and semiconductors, certain areas of it, computational biology, some aspects of it. So I think it's more about, are you bringing to the market, are you developing something that requires that you still work on that innovation, and that the product will probably only work when you're at Series B or C, or the proof points will only be there, versus kind of like you have all the technology tools to build it from like day one. And therefore, you have also IP in a deep tech company, right? You often, the consequence of you having to build that is also that you have like IP protection. But I don't think it's just an evolution, right? Like, there's always mobile platforms used to be considered deep tech at some point. Cloud was considered, if you go back enough, it was considered deep tech because people didn't believe in or it was a completely new concept. And so there's always these cycles of innovations maturing that you have to go through. And there's, along that cycle, various sectors that evolve, as I said, some of the ones that I've mentioned.
And where do you think Europe is on this cycle, the European deep tech investors, in comparison to other parts of the world? So as a starting point for founders, they're from Europe primarily. So this is the playground, and yes, this is the geographical, closest area.
Yeah, I think, again, it depends where you are on that deep tech axis. There are generalist tech funds like us that do, some of what we do is more deep tech. And then there are completely vertical focused funds focused only on deep tech, more, I guess, in the US, like a Lux Capital, for instance. Even those do quite a lot of software, to be honest. No, they're not only kind of pure deep tech. I think where the gap is actually beyond Series A. In Series A, you have also some more mature seed funds, placing some bets in deep tech. It generally comes from generalist tech funds, but when you start going to later stages and actually need more capital, especially as these businesses are very capex heavy, there's where you start not having, frankly, a lot of investors globally that invest in those things yet, but especially less in Europe, right? You have some in China, like Tencent, that would do like large Series C, D rounds. You have some in the US. You have some in Europe, like Bailey Gifford, the Scottish fund, but there's not that many, is the reality. And actually, one of the things we always ask ourselves is also, is this founder able to raise capital later on? Because we can, if we come in at Series A, we can support a company. We can't be the only one that takes the company all the way to a potential IPO. We need follow-on capital, and we always look at various sectors as, are they sectors of interest for these follow-on investors? But overall, it's pretty underserved compared to what's happening in software, where everyone is, and consumer internet to some extent.
Thank you. I can see Ioana raised her hand.
Yes, and I think this is very related to what you have just mentioned about founders being able to raise follow-up funds. So just quick background of who I am. I'm Ioana, I'm the CEO of Convi, and we allow anyone to invest into alternative assets such as luxury watches, fine wine, and our vision is to become the one-stop shop global platform that allows anyone to build wealth with alternative assets. And one of the concerns we've been discussing in the past weeks, now that we are finally successfully raising our first round, is how we are going to raise the next 3-4 rounds. And someone flagged that charisma is really important to founders. And I mean, I don't know, it depends. This is very subjective. I may not be the most charismatic person. So the question is, how do I know that I'm the right person to raise 3 rounds ahead? And how do I train myself to be able to do that? And do you have any tips on that from the founders that you've backed?
Yeah, I mean, look, I think charisma is like, I'm not sure it's right that it's only about like charisma and raising a fund. I think, and raising around, it's the ability to tell a compelling story, the ability to hire a strong team and retain them and build a good product. And those come in very different shapes and forms in terms of like how founders look like. I don't think there's like a profile that you can just kind of like replicate. Everyone has their own styles of telling the story, their own approach to teams. And so I think maintaining kind of authenticity is important. The things I would train on is around how to build the right team, how to hire well, like how do you spot for the key roles that you want to hire? Yeah, what are you looking for so that you avoid, as much as possible making hiring mistakes? How do you communicate really well? Probably that's a critical, I mean, it's a critical component in the world in general, regardless whether you're a founder or not, but even more important if you're a founder, because you have to communicate internally effectively. When you delegate, you have to communicate externally effectively with existing investors, with future investors, with customers. It's a lot about communication. And that's probably one where it's one aspect to train. And then I guess coming back to, like raising 3 rounds ahead. I mean, it's always hard to tell. Like you'll have to see how you evolve, how you feel as a CEO. And there are founders who grow really nicely and learn whatever needs to be learned at every step. And there are other founders who say, I kind of don't want to do this. I did 0 to 1, 1 to 10. I don't want to do the 10 to 100. And there's various ways to solve for that. You can bring in certain executives at that point that do the kind of things you don't want to do or you think you're not good at. but it's also not about like everything stops and ends with the founder. It's a complementarity of like the people around you. So you have to be aware. In my view, what works is being aware of where your strengths are and really playing on that and complementing for the rest with the team. But I don't think it's just about charisma. Charisma is the wrong term, because a lot of it is also about relationship building and trust building with everyone, with all the actors that you have to operate with, right, in your ecosystem. And I've definitely met very charming founders that did not necessarily raise, because if there's not that much under the hood, like people spot it.
Yeah,
Sooner or later, it's gonna come out.
Yeah, I agree. I think the reason why it's been so difficult for us to raise was because we raised pre-revenue, one, and secondly, we're two women that are very data driven, trying to pitch this pre-revenue company. So this is where we started putting up the question: will we be seen better now that we have revenue now, or is it just that maybe we are not interesting enough, we don't have a quirk that maybe investors remember, etc.?
I mean, I don't necessarily, I like to think that most investors are not as superficial, but as like a quirk that people remember. I do think you have to get people's attention in a 30-minute like call you have with them. But that can be done in many ways, right? It can be done with data, it can be done with vision, and it can be done with many things, but you just have to always like loop them into the story and the why and the plans and all of that. And that's regardless of personality. And so I think, that's why I go back to like, can you also hire the right people? Because I think the good investors look at who you hire, because in an interaction with an investor, you can kind of play a very good part. But at the same time, in the and you can kind of like trick an investor in thinking you're charming, or you're like, but actually where the rubber hits the road is like, who do you have around you? And if those people stay, that's more valuable than only one, kind of impression. So I would not invest in a founder without looking at the team around them, even if I had an amazing impression, because nobody's built companies by themselves.
Yeah, that's a good point, and I think we didn't have a big point of, say, advantageous point at such an early stage, but I will try to focus on how fast our team growth in terms of the people we managed to hire.
Yeah, the caliber as well, right? If you punch above your weight and people that in theory should have not joined you join you, that's a good signal, right?
Yeah, thanks a lot.
Maybe from a personal point of view, especially since we're talking about industries that require lots of data, but how do you what attracts you more in regards to risk taking and the founders? So risk taking personalities, or people, academia focused type, the type of stable, feet on the ground, data driven kind of, if you want a classical business approach, or the risk takers? So from a personal point of view, which one would you say would make a strong impression?
I don't think I classify people this way, to be honest, because I don't think academia is the same as like feet on the ground, or it's the same as data driven. Nor do I think that risk takers are necessarily not data driven. Mm-hmm. I think there's like data driven, not data driven. Then there's like where you can be very risk adverse and be not data driven at all. And you can be a great risk taker and be extremely data driven. And there's a whole industry called hedge fund that is based on that, right? extremely data driven, but very big risk takers. So I don't necessarily think about that. I guess what you're trying to ask is about like someone that just waves their hand and is willing to like go for the big prize, but maybe doesn't have that much substance or data to justify it versus someone who's a bit more thorough. But even then, I don't think you can just miss the substance. Like someone will eventually see, like, even if you at the beginning pitch a vision, that's just not enough. At some point, you will have to show something for it. And you will have to show data in addition to, like, the vision can take you, or like the waving of the hands and showing how amazing something can be and telling a really good pitch can only take you that far, like a couple of rounds. It's not going to take you all the way if you're not delivering. And generally delivering means like building a business, building a team, showing the data, you know, having commercial traction, having unit economics, you know, those sort of things kick in. But, you know, I think there is like, but there are so many profiles. If you think about the European unicorns founders, or they're just very different and they've all succeeded in different ways. So I think kind of like trying to over archetype is also not the right thing to do.
We're glad to hear such anchors.
On purpose. It's absolutely fantastic. Yeah, I I don't like fixed patterns myself, but I pushed it to a limit just for the sake of starting the conversation. So thank you very much. I can see Ilya has a question, so I don't want to steal your spotlight. Go ahead, Ilya.
Yeah. Can you hear me?
Yeah.
All good.
Yeah. Hi, Irina. I'm Ilya from BitScout, and we help project teams do more things they love by automating things they hate. So my question is, we are raising a first round, we're early stage startup. We have some revenues, paying customers, and we are in B2B space. So my question is, so the way I think about our current round is what will happen in Series A round, because the configuration I put today will influence everything else. And my question is, based on your experience on working on later rounds, what mistakes founders make when they reach you at Series A or Series B? So what mistakes you see that they were made in previous rounds or before? Everything is good, the story is well, the fun, it looks a great deal, but because of the certain things happened, it's very difficult to fix them already. So what would be your advice, maybe a tactical one?
Well, there's always there's a tactical issue of cap tables, but I think that's less relevant for your business. And it's more common when you see these like university spin-outs where you can't even touch them because the university owns 40-50% of the business. That's like a non-starter. And for us, if a business is not mainly owned by the founders at Series A, then there's something wrong in the cap table. Even if it's like some sort of venture studio, that if that venture studio took 50%, it's a pretty big. So we believe that the founders should be majority like owners and decision makers, because that's why when they have the incentives to build something big. And so I think that's like the easy one, obvious easy one. I mean, I think, I don't know if it's from C to Series A, it could also be from Series A to Series B, that you take too much capital at a too high valuation, especially in this market, and then you have to grow into that valuation, which is all good if you can keep growing. But if for some reason something stalls you, then you end up in this kind of like future round being like a flat round, and that just scares off investors. And it's like, well, I don't want to do the flat round. I want to do the one that's at least 2 to 3 times valuation from the previous round. And I want to, like, to know why, you have to show why you're worth 2-3 times more. So if, especially in this market, right, like people that raise a lot at a very high valuation just need to take on that risk and be comfortable with the risk that they'll have to grow into their current round plus showing up for the future, or bet that they'll always be raising a bit ahead of progress. So I think that's another one. Like you can also, by the way, go the other way of completely undercapitalizing the business and just raising too little and not getting to enough milestones to raise a good enough future round. So the way I think about it is, if you have the round today and you think about the best companies raise between, raise, let's say, every 2 years. Sometimes it's every 6 months in this market, but it's between 18 months and 24 months, kind of on a general base. Let's just plan for that, because even if you raise earlier, you want to plan for, like, generally you get an 18 to 24 months runway with your current round, right? So if you think about that, you think, okay, in 18 to 24 months, what are the 3 things, like the key levers that will drive a 3x increase in our value? What are, like, the really things that are going to move the needle? And if you go through that exercise early on, you'll find that, I mean, because there's a lot of things you can do in a company, right? But it's what are those that actually really move the needle? And then decide what are the milestones that you want to achieve within those buckets and that move the needle, and work backwards from there. And therefore think about how much capital you need, right? Because at least when you go out. So if you think, well, to raise a round next time, I will actually really have to have, I don't know, full, like, this product features and these number of customers and maybe like a few upsells or whatever that is, or these key roles in place, then you kind of can work backwards and think, how much capital do I need to get there with my team? And so so that's how you think about, like, a little bit, like, I think there's an art, it's not pure science, on how you size the round, and the market will dictate, and sometimes you'll take more, sometimes you'll take less than when you plan. But I think trying to not kind of like completely undercapitalize, but also if you overcapitalize it, like, know exactly why and how you're going to grow into the valuation. I think that's another thing. Hires, like mishires, is a very common issue, right? Is the sense of, like, a senior hire that doesn't work out costs you a year, right? Because it costs you whatever, a couple of months to hire them, a couple of months to get them up to speed, a couple of months to get them out of the organization once you figured that it's not working out. And therefore certain functions stall because the leadership was not in place. That's another reason why I think, sometimes people struggle. And then I guess for the more technical products, it's a little bit like takes longer, costs more problem. As in, you've just not achieved, you've not gotten there in terms of really making the product fully usable by the customers for whatever reason. Or you're still doing a lot of service and it's or customization, and it's not really kind of like yet at the point of scaling. Those are other, type of considerations. And then obviously between seed and Series A, you often have to find your product market fit, or at least validate it more. And that's also important to show, right? If that's not in place, it's a harder sell to raise a Series A.
Okay. So if I would summarize, if we have, because we launched and we have paying customers, we have certain data points. If we have enough data points and we understand which capital we need to, triple those data points, and how much we need for that, and what we want to reach in 12 months, and then I work backwards from that number, understanding what kind of capital do I need.
Yeah.
Okay.
And I would work on a probably 18-month horizon.
I plan for 12, but then it's 18, of course. Okay, thanks a lot. Thank you.
Welcome.
Yes, Ioana.
Yeah, sorry, I have one more question. You were talking about bridge rounds earlier, and this is, I'd say, a topic that's more and more adopted these days. And we actually had discussions about rumors of companies. Even one of my co-founders worked at in London that's having difficulties raising Series B, C, because they've been continuously raising until Series A. At the same time, we did try to raise a price round and considered also the concept of a high frequency round, or how Seed Legals in the UK calls it a salami round. I don't know. I think it's beneficial to the founders in a way, because I feel like this would, raising a seed round like that would help us get to that 50% ownership at Series A easier, as long as we do it at a different price per share. So I'm wondering, why are investors, Series A, B investors, wary about that?
It's a good question. Look, I think, first of all, I don't think all bridge rounds are created equal. We have put bridge rounds in companies that are going really well because we wanted to give them sometimes just the peace of mind. Let's say they have 12 months left of runway, they're doing very well, but they still have like 1 or 2 milestones that they want to reach before they fundraise. But the founders aren't comfortable cutting the runway too short, and therefore they want to slow down hiring to maintain the runway. And we don't, we want to help them keep growing, keep hiring. You're doing, if it's like a 3 months to the next, to a critical milestones, that gives them the peace of mind to keep growing the business without being worried about runway. We've done that, right? It's a good problem to have in a way, because you're fueling growth to like be more successful in the way you raise your next round. So, then the investor coming after, it's actually like, it's a positive signal that we as existing investors doubled down and added capital in a high growth situation where there was no, like running out of money problem, right? It was 12 months before the company ran out of money. So not all bridges are bad bridges, just to be clear. I think in terms of, it's an interesting market, but in a way, like, there are top tier seed funds, and those top tier seed funds send a branding signal that it's the same way, like, if Atomico invests, I like to think we're top tier fund in Europe, we send a signal that helps the company with the follow-on route, because the follow-on investors trust us, know us. So I have the same, relationship with certain seed funds, and actually individual those seed funds who I like respect, whose opinion I respect, who I've worked with in the past. And if they invest in a company, I'm going to pay attention, because I know they've gone through a certain process and they're aligned with how, we think about the world. So it's a bit of a signaling element, but then it's not just signaling, it's also how the guidance you get from these people in then building towards the next round, and the network access they give you to their portfolio founders, maybe even like a few key hires help. So it kind of increases a little bit your chances of achieving certain things, because the best seed funds are helping as well. And sometimes it's very tactical help that can make a difference. So to sum up, a combination of, with a more established top tier platform, you tend to get more like better quality advice, more operational help, more network, like access to a different type of like caliber of founders and network, and then a bit of signaling, right? Which we live in a world of perception, whether we like it or not, and we're all subjective individuals at our core, and none of us is perfectly rational, and we operate in a world driven by perception, so that's going to be a factor, but that's not the only one.
Just as a question, just as an example.
Just to say that there are certain type of businesses that are just a much better fit for like a crowdfunding model, right? For instance, there's just like certain consumer brands that may not and do not necessarily want to be a multi-billion-dollar company. All these seed funds are going to look for the multi-billion-dollar outcome, the same way we look for the multi-billion-dollar outcome. But you can have a very successful, very nice business that's maybe like, I don't know, a local consumer brand that still gets to a couple of 100 million, right? And you still own more of it as a founder. And maybe like a crowdfunding model in that case is a better one, because the moment you sign up to a top tier seed fund, you sign up to be forced to grow a little bit, right? You sign up on a VC journey means a certain acceleration of growth, means raising capital every kind of couple of years, means deploying and growing, like, and there are some businesses which I'm pretty sure are not best fit for this sort of capital, high velocity capital. They're better fit for other funding models. And by the way, you can have those exiting either being bought by a corporate or being bought by a private equity fund who looks for like positive unit economic, solid business fundamentals, and would never invest in one of our Series Bs where like they're far away from profitability. And so there's different, like, you know, investing or capital is an asset class with is a multi-asset class with different asset classes underneath it. You have like, you know, you have the growth investor, the private equity investor, the low mid market, the high mid market. It's more about matching the right type of capital with the business. And I think sometimes there's this just like allure of, oh, it's we raise venture capital from certain funds. It's like it's the holy grail and it's amazing. But then there's a lot of untold stories that just don't get that publicized as VC funding gets of very successful businesses. And so I think as a founder, you just have to kind of be honest, like what your business is, and therefore what's the best source of capital is for that business. And I think there are certain, you know, consumer brands is one example where crowdfunding is. Crypto is another one where they're like very different funding models.
Well, there's also debt financing that I think can be very powerful. And I've actually heard of many startups that fuel their round with debt financing. And I do think that will be a good option for us later because we'll be having many assets under management. But so my worry at the moment was imagining I raise we raise seed round at the price per share of 10 and then get a follow-on instant investment price per share of 20, even though the Series A will be at 30, 40. Would that be still good signaling that we got a higher price per share still, but it wasn't a new round, it was part of the same one?
Yeah, I think I don't see a problem with it. I mean, often that's a convertible and it converts anyway in the next round. That's how we most commonly do bridges, but otherwise, I don't think it's a problem. I mean, we sometimes went in companies doing a Series A extension following a group of Series A investors that we liked, and then the company needed a little bit more capital, and then we led the next round, but it wasn't a full Series B. It was an extension of the previous funding. So I think it's completely okay. Yeah.
Thank you.
Same as that. I mean, yeah, you're right. There's also an increase in revenue-based financing, which is generally for very repeatable revenue SaaS type of models. And that financing for sure. I mean, we do it a lot outside our equity rounds. There's sometimes, especially beyond a certain stage, when you have a debt provider coming in, especially in this market, right? With interest rates the way they are. So.
Yes, exactly. That's I'd say one of the USPs of our business. I'll stop. Sorry, I'm taking over the conversation.
No, don't worry. I was thinking while you were discussing, what happens post investment as well. So I can remember you mentioning conscious scaling as a concept that you would apply, or a practice, or I remember you were mentioning that in an interview. Could you please explain that? What do you mean by that, and or what is conscious scaling, and how do you discuss that with the teams post investment?
Yeah, of course. So the concept scaling is it's essentially comes from we think of ourselves as, obviously, when you allocate capital, you're also and when you build a business, that comes with responsibility. So what we mean by that, if the business is successful, there can be positive or negative societal impacts. So what we try to do with conscious scaling is go through this exercise with our companies, which is a bit like if you were to live in a Black Mirror episode and your company was successful, right? What could go wrong from a societal impact point of view? So, and it's actually interesting that, and the reason we're doing that is because if you are aware of potential, I guess, points of failure in terms of the broader impact of your business, you can put in place certain measures, or at least, kind of keep monitoring and be aware that that could happen way in advance, right, before it gets to inevitability. And I guess one example of, the Facebook is the best example, right? Like, you start with what seems to be an amazing connectivity platform that, links friends and families and all of that, to a platform that's then accused of influencing elections in a pretty meaningful way in like one of the largest economies of this world. So how do you prevent those things to happen, even if you're not, Facebook scale? Then if you actually think about it, in most businesses, there is something that would go wrong in terms of a societal point of view. So that's what we mean with conscious scaling in a way in which you are aware of potential points of failure in your growth that lead to the wrong societal impact, or to a societal impact you don't want to have as a founder and as a team. And it's actually interesting for like teams to go through this exercise, because it's something you don't think about on a daily basis. But people that work in the company always get very passionate about this topic, because it makes them think, okay, these are because nobody wants to have a bad impact on the world, right? Very few people do. So that's what we mean with it. And so what we do is we just trigger the discussion, moderate it, but of course it's up to our companies to do it, to execute and think about it.
And how would you describe the post-investment type of support that you offer to the teams?
Yeah, I mean, it's something we keep on building, because it's definitely one of our USP among kind of venture funds, and we want to have the strongest operating platform in Europe as much as possible. And so it comes in different. It depends a lot on what the company needs and what the founders want. We're not imposing anything on anyone. It's a little bit like a menu that you can pick from. And at certain times, right? And sometimes you may not want anything from the menu. Sometimes you may want 3 things from the menu. One of the most common things is building teams. That comes with, we're not recruiting agency, just be clear, but we have operating partners in-house that have scaled, Google, Twitter, and so on, from like 10 to thousands. And so they'll have the experience of like, how do you think about your org structure in the future? And then working backwards, what do you need now? How do you think about your key roles, from the kind of like role description to level, to how do you think about compensation? How do you think about culture? All of those things that come with like really org scale up, from a talent and organizational structure perspective. How do you build your first sales team? How do you incentivize it? How do you structure it? That's where we help a lot. Storytelling is another one. We have a operating partner in kind of like head of communication, and communication is about a lot of things, right? I mean, it's not just about announcing your round, although that's valuable because it gets being in the right outlets means you get the audience of the right people that want to join you. So it's a great recruiting tool, but it's much more than that. It's what's your messaging, what's your elevator pitch, and what's your longer messaging to everyone you interact with, internally, externally, and building that narrative. And then we have an extended network of advisors that are the same profiles as our operating partners, but they're not people we like hire full time or want to hire that would want to do a role like this full time. They're more like functional expertise. So on things like design, on product, on go-to-market, bottom up, top down, on pricing, and these are also same profile of executives that have scaled up businesses and come from successful tech companies. Like on design, we have the former head of design from Stripe, right? We don't need an in-house operating partner to be like a design expert, but some of our companies need it. So we essentially provide a certain number of hours with these people on our behalf. So they can go spend 5 working sessions, for instance, with the team on specific areas, or on pricing questions. You have either experts or even like consultants that could run specific projects for our companies, especially beyond a certain scale. Then we have capital function, which is essentially connecting with later stage investors, follow-on rounds, and managing public processes, connecting with banks if you're like IPOing and those sort of things. We also have a function that we're developing more around commercial introductions, so trying to make kind of revenue generating opportunity, like introductions to potential customers, especially in industries where it's not like tech scale ups where our founders know people, but in some of the more traditional industries that are harder to access. And then we have European founders, unicorns or decacorns, or early employees that are investors in our fund, that are willing to co-invest in certain rounds as angels. And when they do that, or even without that, kind of mentor or have these sort of mentorship conversation or advice with the founders. And again, we have to match that. It's not like it's a manually curated. It's not you have access to everyone and you can like ping them, because it doesn't work like that. But we know, if it's a fintech unicorn and there's like a fintech founder, or we know that if it's a head of someone who scaled sales at a large like tech scale up, we can connect them depending on. So we curate those introductions, but essentially what it is, a lot of this is access to like real expertise that can like roll their sleeves and help you, or a network you wouldn't access easily otherwise. But we're still building that. I still think there's kind of a lot we have to do to keep building the platform.
And I suppose there are two sides. So it's companies reaching out for help, so asking for your help, and then you have a sort of an agenda where and that turns into a question. So you've got sessions, for example, the experts in residence, or you've got sessions with dedicated partners or experts that you bring along at a certain frequency, and then you ask the teams if they're interested in that topic, similar to what, for example, we have today, Q&A. So do you have a structured, let's say, program for them, or do you work more on by demand? So when they need your help, they'll just reach out, and they have this access to a pool of expertise at their hands?
It's more by demand because we sit on the boards, so we have quite good visibility on the various things. We are often the lead investor, right? So we generally like sit on the board and are among the few investors around. So we know quite intimately We're quite involved with the founders, like on WhatsApp with them. So we know what they need, and we just suggest that proactively. They kind of know, we make sure they know the menu, so to say, and what they can use. But then it's also up to us to, occasionally like even prompt it, hey, you should talk to this and you should talk to that. And there's a difference. We don't have, because we're not a seed company and a seed, like a early pre-seed type where there's no company formation, and it needs a bit more customization, right? We invest, like some of the Series A companies or late seed that we invest in have 6-8 people and are just starting. Others have 50 people, like 40 people, and have already figured out certain things. They need different things, so we don't put them through a single program. We do have a bit like, we do have like events, so we'd have like roundtables on engineering or on product where we invite people. And so that is an opportunity, and it's generally small groups of 15 people, so it's an opportunity for them to ask questions and to learn. So it's a bit like a teach-ins, if you want, but with we do those quite regularly. Those are the things they can kind of like opt into, but no, not like a proper program. And I don't think we'll do that anytime soon, because we don't see necessarily a need. Then you don't want like founders to feel like you've imposed something on them. Like if it's not helpful, I mean, some people have capabilities in the team and don't find it helpful to use certain things, and so we wouldn't impose to use that.
Absolutely. So let's move the focus a bit on Europe. What are the advantages of being in Europe for the team? So what do you think makes Europe a great place to be today, now in November 2021?
Well, I think first of all, there's no like limits now to where you can build your business, partly because of COVID and the way Zoom has democratized access to, investors will just jump on a Zoom much more than feeling like they need to jump on a plane, but also because there's now success stories, right? And so people believe you can actually build businesses out of Europe, and it's been proven, which was not necessarily the case 5 years ago. I think one really important advantage in some areas is around the ability to hire but also retain talent. A lot of our companies that have offices both in Europe and in the US have a much bigger churn in the US. So, to retain engineers, you have to keep paying a much bigger churn and more expensive resources. To retain and just hire engineers in the US, especially in certain areas of the US, is a very different story. And here you still have some sort of like arbitration of salaries just aren't that high, and also partly because costs of living in Lisbon or Serbia is not as high as Silicon Valley. So there is still that. The flip side is there are some areas like product is harder to find in Europe, and B2B marketing is harder to find in Europe because most of the people with that sort of really scale up expertise is still in the US. But I think access to like the talent base where it's still, you're also not competing with that many companies in every little ecosystem in Europe, right? As you are if you are in the US. I think that's still quite powerful. And I think the message is it doesn't matter as much as it used to matter. Only if you have to deal with German notary, which, is kind of like a very, very different story. If you've ever had to like do a round in Germany, you'd understand why you may want to ask them to move to the US or to some geographies where you don't have to spend 10 hours signing notary papers. But that aside, there's, it's really much more global. And I think the mindset of US investors has completely changed, and they're going to places in Europe they never used to know existed as cities, right? So.
Yes, that's true. And since you're mentioning, how COVID has impacted and brought some changes into this, of course, we have to discuss this. How did you feel the health tech industry changing over the last 2 years? So what are the main differences or trends, or what are the things that you feel are completely different and new and will be different in the future after well, if there will be such thing as after COVID, but let's just say after we get used to being in this COVID scenario. So 2 years later, we're still here. So how did you feel the health tech industry changed over the last years, and where do you see it going in regards to changes and to how this will impact the startup ecosystem?
I mean, there's positive and negative things about changes like this always, right? So it clearly accelerated, not just in healthcare. I think in a lot of other industries, it has accelerated the adoption of technology, because when you're stuck and you cannot do, physical visits, physical deliveries, or physical, consultations in this case, or physical sales processes in enterprises, right? Then it just changes how you think about the possibility of doing something. I think the biggest unlock in healthcare was people saw that it is actually doable and it is possible, and it's not really creating any major issues that they may have as a risk adverse industry thought it would create. So I think adoption of technology, especially in terms of like the delivery of care at like primary care level and those home care and those sort of things. I think it did delay certain aspects. Like, don't forget that healthcare capacity was locked into like providing support for COVID, which meant clinical trials were harder to recruit for, which meant certain diseases got deprioritized even from budgets, which meant sometimes screening programs got delayed for, like breast cancer screening and those sort of things. And businesses serving that part of the market got some negative impact. So, it's a two-sided story for sure. But I think overall, healthcare and beyond, there's definitely acceptance and acceleration of technology penetrating it.
That's great, thank you. I think going to your previous.
Just so Ilya, maybe you want to jump into this thread, or
Yeah. So that we don't.
No, I actually wanted to go a little bit back about you mentioned about the impact of a startup more on the society, and I just wanted to maybe have your opinion. Here in Spain, interesting thing happened with one of the delivery companies, the food delivery companies. I don't want to name it. So what happened is, so they created basically this rider market, like Uber did, like delivery. They created this gig market. Essentially, the algorithm was setting a job for a person. And then from point of view of government, they hired them as freelancers, so free riders. And the contract was digital, so it was 8 hours contract every day. And lots of riders started to complain, and then they filed the Supreme Court thing that it is a violation of laws. And now the laws, they have won, the riders have won against the company. And what happened is, according to the calculations, first of all, one company just left. They said, we're not going to operate in Spain. That's it. And every other rider, they made a very interesting calculation that now with this law, when the company has to hire them as employees, they will receive almost 30% less, and they will have to work almost 25% more. So you have like two pieces of the puzzle. From one hand, you created a gig market, which is very kind of unregulated, and because it's a machine sets you work, it's like lots of challenges in our head, like. And then from the other hand, we kind of fixed it like we do. And now it's a bigger problem because people became poor, just the wave of the button. So I would wonder your opinion, because the point here is that the technology company just made the technology. They were not trying to influence the laws or something. That's not what the target was. It just created a very good software that can do in real time those things. And it happened to be very useful for people. And now it's like an imbalance happening. So I would imagine myself being a founder. And if I like our great idea that we have can also do that change. And I don't know if I really want to do that great change and or enter all these challenges, because that's not the challenges I really looking for, fighting with the government and stuff.
Yeah, and I mean, that's why the work around these the topics of conscious scaling that I mentioned earlier, right, is one of these things which is never urgent until something bad happens. But it's important because its impact can be disproportionately negative if it comes true, right?
Yes.
So the only thing you can do as a technology company is realize the power you have in your hands the moment you develop a certain technology, and think about how it can be misused, how it can be, kind of like judged as or caught into these sort of situations, right? What's the wrong consequences that it can also lead to. And some of them you'll accept, like you'll be like, okay, I'm going to take that. I'll accept that negative impact because I think I'm generating much more positive impact, but some will be much more meaningful. And at least it prepares you for things that could happen and make you aware when you're approaching a situation like that. And maybe there is something to be done before something blows up. It's very hard to do something after something blows up. And that's my point around trying to think sooner. And I think as investors, I mean, that's why we had this big debate recently around, should we invest in this AI company who's one of the main revenue generating sectors, and one of the main customers is defense, right? And ethically, around the same table, it's interesting, you had very different points of view. Some people said, well, by having a seat at the table, we are on the board, we have like all sorts of like rights in terms of veto rights on certain major events. We actually can influence, and we actually can make sure bad things don't happen and the technology doesn't get used in any wrong ways, and it's much more powerful in terms of the impact we can have. And others that were like, but what if it happens? There's a tagline of, Atomico backs like whatever military software that I don't know does this and that, like the whole platform and brand that, and also like what we stand for gets completely diluted, and then you have to like make your way up out of there, right? And in the end, we decided not to do it. But then there are funds, like if you look at Founders Fund, that's the view they take, that by having a seat at the table, they're like top US funds that have selected to play. And it may be a difference between, defense in US is like military is like a much more glorified than it is in Europe, and some of those things. But we had that discussion before. We looked at other businesses where, for instance, democratizing writing, it turns out a lot of it was more like erotic novels. Like, do we even, what do we think? In a way, it's giving access to writers, to platforms and all of that. And other things like content is of a particular nature. Like, do we want to bag it? And again, we decided not to do it. So I think the best thing you can do as an investor is the same thing you can do as a founder. Think about what can go wrong and whether you're comfortable taking that risk or not. And sometimes we are, right? Sometimes we're saying, okay, we'll take that risk and we'll try and manage it. Much harder to do in retrospect. Once it's done, and once the snowball is just getting bigger and bigger.
But what, like, think maybe, well, defense is, yeah, US, they have a different view on that. That's definitely. But let's just think about a company that does encryption. And like you can encrypt and you can protect data, your own data, which is a valuable protection, but you can protect something else, some more dangerous data. But still the company is an encryption company, and like they just provide the technology, like a computer. You can do amazing things with the computer, but then you can do not so amazing things.
Yeah.
So that's never written in the, you know, when I read about, when you go to VC page and you start reading and like all the nice things, like we back only ambitious founders, and then, you know, but it's never written between the lines that there is like, oh, we don't back if you do encryption, and that some people use it without you knowing that, you know, that's not written there. So how, like,
I mean, look, every technology can be used in a bad way in some way, right? So, but I do think it's very, like, even with encryption, right? Like if you're selling to enterprise customers, for instance, you're somewhat de-risking, like, versus selling to like a broader, you know, just letting it out in the wild. Yeah, I think there's those choices as well that you make around how you build a business that make that risk be higher or not. But I guess more to like higher level of the question. I mean, I do. You're right. We do say we back ambitious founder, game changing, and so on. But I think we also say that we, you know, we care about the impact we have on society to the extent we can. I mean, look, we're not like, we have some responsibilities as capital allocators to the society, but we're also not aware that we're not politicians. We're not like NGOs regulating industries where there are certain things that we are not trying to do, right? We're not trying to be this kind of like save the world people, right? Yeah. We're just trying to back businesses that have good people that think about these things and don't kind of like, you know, hope that they don't backfire, and do everything we can when we make the selection process and where to invest, when we work with the companies and so on, to think about doing the right things. And I think more than others, we draw pretty strong lines, and when it's gray, we'd rather not, or would rather potentially not do a good investment than risk that impact. But I'm sure there's tons of things none of us is able to guess about technologies reaching, right? Quantum computing.
Yes.
Right? Like, it's kind of inevitable that we'll need it to solve a lot of things. It's also inevitable that at some point, quantum computing, the same as internet, is going to be used to, but it's not the company that invented one quantum computer that's really responsible for all quantum work that's being done later. I think it's a problem of progress, right? Like, it's always going to have a negative impact.
Yes.
In some ways. It's more about the net.
To some audience, it is always kind of has a negative impact, and some audience have it positive. So, but yeah, okay. Thanks a lot for your comments. Thank you.
I jump in with something, Irina, and to all the founders, because if there's something that you want to add, I would leave the space for that. But otherwise, I'd have a curiosity, or as we open this Pandora box, wanted to ask you to help us, and by us I mean the founders. We consider ourselves as a part of their teams during Spotlight. Because losing focus is something that can have very high consequences, very deep consequences. Could you help the founders to figure out what does the VC, such as Atomico, but these Series A tier VCs don't focus on? And when do they actually get into their radars, so that they can keep the focus that they have now for the things that can move the needle? Could you clarify this for us?
When you say don't focus on, do you mean certain categories?
Don't get in contact with founders, or they do look at some industries, but how mature they should be, or to the founders, they may interact in some open instances, but they don't get to one-on-ones, or what do they do and what do they don't do related to early stage tech startup founders that didn't reach yet the Series A moment fundraising, but they are on a trajectory of raising venture capital?
I think, it's never too early to think about who your best Series A investors are going to be. And there's always a combination of who you would want them to be, but also who will realistically be a fit, because each one of us is kind of a little bit different. In certain areas, I think in some areas we all play, but then I think there's certain, and then also, so have that sort of map built over time rather than in the 3 weeks when you're trying to raise, and have the relationship developed a bit earlier, because that one gives you insight into, are these guys likely to lean in or not? Do I like them? Can I work with them? And then you'll kind of start to see, okay, these ones seem to be more interested. And you go from like a wish list to a more actionable list in some ways. And then you build a relationship, and it's easier for both sides to come to the table, when the time is right. That's probably, quite important. And I can see even among our founders, some are better than others at building relationships with follow-on investors and thinking about their follow-on rounds. And some don't want to do it because they think they're never ready, and what are they going to tell to people? And, it's a balance. Like, you also don't want to do it too early, and you don't want to burn bridges. But I just having a list of who those are is helpful. Makes the process of fundraising also a bit less daunting, and it opens up the ecosystem so you can actually explore.
What can be helpful for founders in doing that? Because I assume that they get stuck into seeing the investors as too high for them to actually engage with them. And when they engage, they act from this position of, am I fit now? Is it the right person that I should be talking to? Do we have some chemistry? How can I figure this and that? And with so many questions, you actually get into analysis paralysis, rather than using tricks like, not necessarily, but as you do when speaking in public, imagine the people are dressed in bathing suits. Maybe there's some workarounds to that as well, to see the investors more friendly they seem to be for founders.
Yeah, I think it's interesting, because I do think if you're a founder in London that gets courted by everyone, you have a very different view, in which, if anything, you feel very self-confident and cocky towards investors, rather than the opposite of like, oh my God, I'm scared of them, right? So, or if you're building in a space which just has a lot of appeal because it's a great fit to the venture asset class, and to what venture invests in. And so people just like the space. But I think in general, like, it's not, you don't go from like zero, you've just started a company, to necessarily talking to, you don't have to kind of like go and talk to some American fund from the day one, or like a big Europe. You can also like play in your ecosystem, get the seed funds that are in the ecosystem connected to. So we have relationships. We can't have teams in every country in Europe, but what we do have is we have relationships with seed and pre-seed funds in all of these countries. So if one of these funds invests, then they generally can make an introduction, and we will generally take it more often than not, unless it's kind of in really a space we don't have any conviction in which case we don't want to waste your time. But more often than not, we will take it. So that's one. Second, we have, and you can see if you look on our website, team members that cover certain geographies, right? So we have someone for CE, we have someone for Nordics, we have someone for France, Spain, Italy, Portugal. So kind of, and we have someone for Germany, a bunch of people for the UK because it's a large market. And so those are people that are, you know, they're not all actually, some of them are a bit more junior or associates to principal, so but they're in contact with us. So we can't be present everywhere, but you can reach generally one of our team members. And I think, you know, for me, can you get to like, you don't have to get to me, but can you get to someone in the team, especially the one that covers CE through your local network, for instance, if you're based in the CE or in the Nordics, is also a sign of how are you hustling, because the world is quite small. Like in the end, you're navigating, we've all done that. I mean, I'm doing the same. I'm sometimes trying really hard to find, I can't get to speak to a founder and I really want to speak to them and they don't want to speak to me because they've just raised a seed round and they don't want to talk to any other investors. And then it's up to me to find 5 ways in to try and get them to speak to us through like connections. And sometimes it's not easy, right? Like sometimes I don't manage to get there. I think it's a two-way.
It's an interesting perspective, yeah, that you're showing. Thanks.
Yeah, so I think, and also, you know, then I just have to accept that, okay, all our networks, and I ask my colleagues and I ask everyone, and if we still can't manage to get through to someone, I mean, sometimes we just can't. But sometimes it takes a lot of time. I mean, today I've just before this call, I've gotten a reply from a founder that I've tried to meet through 5 different people, right? I had 2 of his seed investors telling him, I wrote him, I had a colleague that knew his friend, I had a colleague that had, and finally, after all this, I got like, you know, a half an hour call. We have the same issue after, you know, if it's like experienced founders in spaces that we like. And so. Yeah,
this bridges a bit the gap. Yeah.
Yeah. It's like no one's some sort of God sitting out there and you know, but I do think that I think in Central and Eastern Europe, there's still, because the ecosystem is small and it's just building, there's like a gap a little bit in access. I think that's being narrowed now, but historically there used to be a gap in access. And I would see myself like sometimes to raise a Series A, if you were like a founder in the UK that maybe did another business and so on, and people knew you, there's more seed funds that would seed you than there were in Europe. Like in Romania, where I'm from, like 5 years ago, there were very few seed funds, right? So now at least you have some local seed funds. Even if they're small, there are like, you know, a couple of them that can actually now start generating that. And those are how ecosystems develop. For Series A investors, we can't go and pre-seed companies. We need to rely on people to invest before us.
Got it. Yeah. Thanks for putting this on board as well. I'm leaving the floor now. Thanks.
Actually, this reminds me of some other questions we had in other Q&A sessions in regards to these geographical boundaries. I am aware of the 5 minutes left of our session, so if you cannot stay longer than 5:30 on our time, then
yeah, I can just be a few minutes late, but I'll have to go because I do have a call.
Yeah, definitely, totally understand. Thanks. Then if the founders want to add something to that, or if you want to leave the founders with some thoughts, we'll do it, because then Ioana will take just a quick recap of the conversation within an interview.
So guys, do you have like one last question, or can we do the 1 or 2 questions of the interview? So
yes, I have actually a very quick question. What is the company doing, or that you mentioned that you were chasing to speak with this founder? So can you give some example? So at least we will know where to.
Well, it's one of the areas I've been spending time on is data infrastructure and tooling, and it's basically a company in that space that I just think has kind of an interesting like an angle that I was looking to see, and I haven't seen companies before doing that. So, And, you know, I may still be disappointed. By the way, what I forgot to say is that sometimes I do all of these efforts. Meet a founder, and I'm like, okay, that's not really what I was expecting. Our job is about kissing a lot of frogs and saying a lot of no's, which is actually very hard, because it never, like, nobody likes that part of our job, like saying no to people that put their lives in building a company. Like, that's not the fun part.
Yeah, that's a great statement.
Very much for your candid answers and for for being so open. Great. So now on the remaining couple of minutes, if you don't mind, just maybe turning the laptop.
Yeah, just tilt a bit towards you. So
Like what, like this? Or you want me to be like this?
I think, yeah, that's it. So we can see your you can see yourself. So basically,
Like this. Is that better?
We've
amazing.
that through the interview, but just to wrap up. So what are the key components you evaluate when you make your investment decision in a startup?
So I think there's some of the things I've mentioned at the beginning, right? A lot of it starts with the founder and the way the founder thinks about the product and why they're building what they're building. That means a few things. That means, do they have a differentiated insight into the industry they're building in? Do they have a deep thinking about the product and how they're going to build it? Do they have the kind of right commercial mindset, or have someone in the team that has it around how you actually build and scale a commercial proposition in that space? We also look at the potential of the market and the market readiness. Actually, the market readiness is probably one of the hardest things to diligence, and also a very common reason why we sometimes pass on opportunities. The nature of our fund means that we have to look for opportunities that have this kind of like multi-billion-dollar potential, which means markets that are uncapped to some extent, or they're capped at a high, like, billion-dollar mark. And also that where the market is actually ready to adopt at scale quickly, or relatively quickly, right? Like if the market's 20 years away, it's much harder. And I think that's probably one thing I spent a lot of time on, in addition to the founder and the team. Then the other thing we look for is the ability of the founder to recruit a strong team around them, and self-awareness around where their strengths are and where they actually need to bring in complementary talent, and what that caliber of the talent is. You know, it's always a great sign if people that could have gotten a lot of other roles decide to join a Series A startup, then take a huge risk maybe for their careers, and also financial risk. So that's always super important. And then the other thing we look at is, you know, customer feedback. At the end of the day, that's one of the most powerful tools we have in terms of diligence. Like, what do customers say? Is there that sort of like customer love that you would expect, that solves a really big pain point, that the product solves a really big pain point? So I mean, it's a very like a multi-parameter equation that we're trying to solve. And then we also think about how can we add value, and are we best positioned as an investor to support and help this company grow. And you know, if we actually feel we don't, then I think we think twice. But we definitely think of that part as well.
Great, thank you. So what would be your, you know, top pieces of advice for the founders in Central and Eastern Europe? How should they leverage the fact that they're here in this part of the world? What's your advice for them, taking into account that these are CE startups, let's say?
Well, I think not be too labeled by the fact that you're a C startup or not. Like, it doesn't matter so much where you're from. It matters where you're building, what you're building, the space you're building in. There's a lot of other elements and geographic considerations. I think in terms of like geographic considerations, you know, use the advantage you have, I guess, in terms of like recruiting talent, retaining them, because some of these markets, while they're competitive, they're less competitive than other ecosystems. So you can still hire high caliber talent that stays, and that's powerful. I would say, you know, use the local investor network. Even if they don't invest in you, you can still get to know them and so on, because they often provide a bridge to like the later stage investors. And then try and build relationships with a European and US ecosystem sooner, you know, as soon as you have something to say, and try and build that relationship with investors and with customers and so on as soon as possible. And think global. There is no reason to not think global. Think very quickly beyond like the boundaries of the market, or how your customer base or how your local enterprise customer, for instance, system think about the global market.
Great.
Would be my top tips.
Thank you very much. And are there any particular advice you would give to deep tech, health tech, so to the startups, let's say, in the industries you're closer? Are there particularities in regards to advice you would give to the founders that operate in these industries?
Well, I mean, I think deep tech's one thing, and vertical software in certain industries like health is different things. I think in deep tech, you always have to think about your capital journey and how do the milestones, because don't have commercial milestones, you have technical milestones, and you have to make sure you're working towards the right technical milestones that match the capital, what the capital expects you to show, right? What the capital providers expect you to show. So I think there you need to think a little bit more about that, and not undercapitalize, plan for all the buffers of things being delayed because you are working on sometimes unknown technical challenges. I think in vertical sectors, there's always like, you know, particularities of various industries. You know, in health tech, I think when you're selling clinical software, it's very different when you're selling non-clinical software, which means that kind of the challenges and the regulatory barriers are much higher in one than in the other. And therefore you have to build your business and plan again your journey accordingly. But I think overall, I would say it's you know, it's still a great time to build like vertical software in these industries that have now started to digitize. The one caveat is, you know, sometimes it's very easy to think that because it's obvious, the market is going to adopt it, and there are realities of complacent industries where adoption may take longer, and thinking about how to circumvent that and how to trigger that adoption, what product you sell to whom first, from a commercial perspective is worth it, because they're still quite conservative spaces.
Great. Thank you so much, Irina. It's been an absolute pleasure, and it's been extremely useful, you know, 1 hour and a half spent with you. Sorry for keeping you longer than 5:30 or 3:30. And you'll hear from us with the updates in regards to this short interview as well.
Yeah.
And the founders will have the session with you to look at all over and over again. So to recap some of the things we've highlighted today. So thank you again so much for your time.
Thank you. Thanks
It's
a lot.
been a real pleasure.
Thank you, everyone.
Thanks.
Bye.
Enjoy. Bye-bye.